whenever I hear people ask the question, well, what's going to replace the dollar? There's just no alternative. If that's your argument, then none of the fundamentals that supported it, that got the currency there in the first place, are there anymore. Your only argument is there's not yet a contender, and the key emphasis there is on yet. And so there's a lot of momentum behind the dollar. I think the biggest thing that will keep the dollar around much longer than people expect is the amount of dollar denominated debt there is around the world. But one policy mistake of too rapid inflation for too long can wipe away the value of that dollar and cause a reset, and a new currency will take its place, regardless of what it is. It's just you make your currency less. Exactly. It happened in Germany. So you make your currency less attractive and something else will replace it. It doesn't matter whether yours used to be better or not.
That's interesting. That was some really good points. And folks, I know some of the stuff, that you're hearing, you're like, it doesn't apply. It does apply. And all you need to do is just go back to history class and what happened with Germany. Because like literally that right there is really what we're staring down the barrel of. I mean, I think they're getting the handle on it by taking drastic action, and it's coming at the expense of every American citizen. But I also think one thing that Americans can't quite comprehend, and I totally understand it, is we do live in the greatest country on earth. I mean, we have the most freedoms. We have the biggest opportunities. So when you're thinking about other countries being attractive, like China, I mean, right now, there's not a single American, at least I think there's some that should, but there's probably not many that would be like, oh, I'd rather live in China. But if you lived in other emerging countries where the country like Africa, for example, China probably looks like a really good place to live with opportunities and development and everything else. So sometimes the grass isn't greener on the other side simply because you have the best grass on your side. And if you flip that and you lived in another emerging country, China might look really attractive. So I think that's an interesting thing that I guess I never really thought of. But let's go to the next step and let's push the pedal down a little bit. I think a lot of people right now have a lot of fear. Rightfully so. I mean, we've gone through some interesting times politically. We've gone through some interesting times with the pandemic. And we've also been brought to a point where we really don't know what to trust. We don't know if we can trust the news. We don't know if we can trust politicians. And I completely agree. So there's a lot of distrust right now, but there's also a lot of people that feel we are going into a recession. I mean, the inverted yield curve's never been wrong. And I haven't studied this yet. Maybe this. I think this is the deepest we've ever been inverted. Maybe that's fact. Maybe it's not. But the inverted yield curve has never, ever, ever since I think since World War II, if I'm not mistaken, ever not led to a recession. But if you talk to the politicians, they say we're not going to a recession. If you talk to the Fed or you listen to the Fed, this is going to be a soft landing. Like, what do people have to do to believe things are going to be okay? Or do you just think right now it's hunker the hatchet, bunker down, get the hatches tightened up, get the family affairs in order, because we're going deep into a recession, if not the next Great Depression, as some would say? Where do you think we go? I mean, because honestly, I can't believe the markets have been as resilient as they have, but I think this is like a hangover from a really heavy night of drinking. I mean, when the Fed printed all that money, I mean, that money's still in the system, even though they're pulling it out, it's still there and it's hanging in there. And gosh, sometimes I'm just like, when is this going to drop? What are your thoughts moving forward? Let's just go. We went back, but let's go forward 3 years from where we're at now in terms of all the signs and the economic conditions that are happening. Where do you think we're going next?
Yeah. Great questions and great points. One point of clarification on the yield curve: there's never been a recession that hasn't been preceded by a yield curve inversion, but there have been 2 yield curve inversions that were not followed by a recession. And so every time there's been a recession, you say, okay, looking back, yeah, the yield curve inverted. But there have been a couple times when the yield curve inverted and then nothing. No recession took place after that.
One was not that long ago, if I'm not mistaken. I'm not getting the years right, but within the last decade that happened.
It could be. I don't know the dates on them. But yeah. So that being said, I think the steepness of the yield curve and the reasons why it's inverted are a big reason to think that, hey, yeah, we do have a recession coming up. When you take a look at when you take a look at the money supply, like we were talking about earlier, the Federal Reserve has been shrinking the amount of money that's in circulation. It's certainly nowhere near where it used to be prior to 2020. That's certain. But we have so much more debt than we used to. And so when you take a look at, a lot of people say in order to bring down inflation, you have to get positive real interest rates. And we haven't had positive real interest rates for a long time. We do now, but they weren't for, forever. And so they take a look at, okay, if the inflation rate is 5%, but interest rates are at 4%, then interest rates are still negative from a real standpoint. Now they're finally positive again. So inflation is 3%, interest rates are 5%. So we've got like 2% interest rates real. And a lot of people are saying that's nowhere near high enough in order to combat all the craziness from the last, 2 years, from the last decade. The problem is when you look at the amount of debt. So imagine you have $10,000 worth of debt and you make $150,000 a year. It really doesn't matter what the interest rate is on that debt. You're going to be able to pay that off. Like if the interest rate is 5%, you're fine. If the interest rate is 20%, you're fine. Like it'd be hard for interest rates to get to a point on $10,000 worth of debt if you're making 150 for that to be an issue for you. And that's where the country used to be, both individuals, corporations, the governments, both city, state, and federal. That's where things used to be. The debt used to be a lot lower than the income. But over the past, really, it's been about 10 years now of very low interest rates. And then in 2020, zero interest rates with all the money printing. It allowed the system to lever up like it never has been before. So the United States government hit 120% debt to GDP ratio. That's banana republic levels. That doesn't happen. The only time that's happened in U.S. history is during World War II, and you could just stop the spending when the war ends. And so, yes, that mattered, and that was harmful to a lot of Americans. But the spending could stop after, when the war ended. We're not fighting a war right now. It's all mandatory spending, discretionary spending, Social Security, things that it's political suicide to end any of that spending. And so when you look at the debt level and realize all of that debt was borrowed at zero interest rates, individuals too, corporations also, governments, all of that was borrowed at rock bottom interest rates. Well, when you move from 2% to 4% interest rates, that doubles your debt service cost. And if you were already maxed out and you could barely make your debt payments at 2%, 4%, you're bankrupt. It doesn't matter whether that's below the rate of inflation or not. That's going to be some extreme pain. And so because of the leverage that has built up in the system at rock bottom interest rates, and now interest rates are way higher than they were 2 years ago, that is the pain that's starting to set in. We're going to see some deleveraging. Now, it's possible that we get an inflationary deleveraging, meaning the Federal Reserve comes in at the point of maximum pain, lowers interest rates, prints a bunch of money, bails out the government. We get an inflationary deleveraging where the value of the dollar plummets, wipes out the value of the debt, the lenders get screwed, and the borrowers make out clean. And we start over from a position of way higher prices. It's very painful. You have a lot of scarcity because deleveraging is always associated with scarcity because you've already spent that purchasing power from the future in the past. That's what leverage is. And so there's still economic pain. It's just done through prices going up rather than prices going down. Right now, at least for the short term, we're doing the opposite. We're looking at a cliff of deflationary deleveraging, meaning interest rates going up. That means less spending across the board. That means some debts will get defaulted on. That means we have less money going around. And so you still, again, have scarcity. Ever since the Great Depression, we've had inflationary deleveraging. That was a deflationary deleveraging. And so you can think of that as an example of what I mean by this. But prices collapse. Again, it's just hard to get the things that you need. Either way, though, we are going to experience a deleveraging. And I think that will probably happen over the next couple of years. That's what we're looking at. We're looking at a recession really soon here. We're looking at prices going down pretty soon here. And the only one that I would anticipate to get a bailout would be the federal government. If push comes to shove, the federal government cannot borrow enough to pay off the debt that it owes and pay its bills. That's when I think the Federal Reserve will step in and copy Japan, do yield curve control, bail out the government, but everybody else has really high interest rates. Now, I want to make one note because this sounds like doom and gloom. And I always need to emphasize that recessions are the cure for the malinvestment. They're called corrections for a reason. It gets us back to where we're supposed to be. It burns off the dead wood. It forces people back to the incentives of saving, preparing, being wise with their finances, not overextending themselves. And so it is painful, but it's healthy for the system to be able to experience this, number one. Number two, for anybody who is prepared, that's just opportunity. How nice would it have been? I see a lot of people comment, like I see videos pop up, kids that are, 21 years old, saying, man, like my biggest financial mistake was not buying a bunch of real estate in 2010 when I was in preschool. It's like, like everybody looks at that and says, okay, that was obviously in retrospect a great time to buy assets because they were on sale. That's what recessions do. So for the prepared, it allows you to get things at discount prices. And so this represents opportunity. And then the final thing is that looking really optimistically, sometimes deleveragings are not accompanied by pain because you deleverage through an increase in productive output. And so this was like after World War II, we deleveraged without experiencing a lot of pain because we basically doubled the workforce. And so we had, because of women going to work and then men coming home to work, we had a massive increase in productive output. So that offset the economic pain. We don't have that ability. We don't have people we can call home from war now. I mean, we do, but not to the same extent. Women are already all working. And so you look at a couple developments that I'm bullish on right now. A resurgence in nuclear fission energy, the potential for nuclear fusion, AI, and this is brand new, but the new room temperature ambient pressure superconductor that could be real. Any of those four things really take off, we could see a massive increase in productive output and wealth increase that could offset the pain of a deleveraging. So those are like, if any of those turn out, that could be a way that we see no pain in the next 10, 20 years.